All right. Good afternoon, everybody.
Hey, what's up? Let them in, let them in.
Hey, guys.
Right. Means you guys, hey, make sure you guys mute on the way in, okay? They're gonna have a lot of people in there. We need to minimize the background noise. We can always raise your hand and we can unmute you if we get to a question. So, yeah, we're gonna get started here right away. We're gonna go into the model and go through some of the revisions that were made. We're gonna walk through this whole process. So everybody, we haven't done this in a while. Just make sure a lot of new people in the group that you understand how the model works, how to download it, how to save it, how to do everything so that we don't have any mistakes, because when you make mistakes in the model, it screws up exactly whatever it is that you're trying to do. So I just was trying to clean one up earlier today. So we're gonna work through that here pretty quick. We'll add a few more people in, and we'll get right to it. I don't think. Let me just try this one more time. Did you were you able to stream this on Facebook, Eric, or no?
I'm working on it. I'm just trying to.
Hang on. I just did it. I think I can do it here. Hang
okay.
On. Should be a group. It looks like it just something opened up. All right, cool. All right.
Yeah, we like to we wanted to stream on Facebook just because if you guys want to go rewatch rewatch what we're doing, it's on Facebook. So if you're in the group, you obviously get the opportunity to do that.
Yeah, exactly.
There's questions that maybe you didn't get answered, or we didn't tell you about, or didn't remember, whatever. You can always go back and rewatch it.
Yeah, I mean, we have almost 4,000 people in the group now, and a lot of people go back and watch the replay. Some people can't make it during the day. They deliver mail, they drive trucks, they have a daytime job, and this is when we do it, but it doesn't mean that people can't go back and review it and watch it over and things like that. So we're gonna get rolling here. I am going to share my screen, and I'm literally going to start at the very beginning of the process. Where is that screen? I don't have it up. I gotta open another window. Give me 1 second. I had it up here. Here it is. Let me see if this is it. When you're running the Zoom and everything, it takes a little bit to do it. So I'm gonna share my screen. What I'm gonna do here, you see the screen okay?
Yep.
It is the model, but the first thing you guys have to do is you have to go download the model. So I'm just gonna, it's just, you can go right, there's the links in the link is always in the resources inside of Facebook, okay? And if you go to cash flow deal machine, at least this is where it is for right now, it'll ask you to download it. I'm already in it, so it's already there. You have to download it, you have to make a copy, and then you should rename it, okay? So take the copy out and just name it whatever your company is, okay? And this one's gonna be called, I'm just going to call it ABC Company, okay? I'm just going to call it test. So we have it, okay? Then you save it, okay? Once you save it, then I would highly recommend saving it to your drive, because if you're ever going to share it, you're going to want it on the drive. You don't want to download it to a computer, because anytime you make changes or edits or any of that stuff, you can't go back and no one can see it. It doesn't do us any good, especially if you send it over to us. If you're partnering with us on a deal or something like that through our Creative Dealmaker Academy, you have to do it this way. Otherwise, we will not be able to make edits. We will not be able to share the details back and forth. So download it, and you should be able to make a copy of it. And hey, Elvia, do me a favor. Go in, and I see a lot of people in here. They're probably downloading it now. Just make sure the set, you know what, I'll just check it right now. Hang on. Let me see if I can see. Should be view only. Okay, yeah, viewer. Okay. Anyone only can view it. Perfect. Okay, good. So that means you can view it and you can make a copy of it. You can download it. You can put it on your drive on your computer, but you should keep it on the drive as well. So this is the new version that we're in right now. This is 3.2. We literally just released it, and we're just going to walk it through very specifically on how this works, why it works, and what it should do for you, okay? The yellow fields are the fields of input, right, where we're going to put it in. Everything else is a calculation, okay? If you look down, this video actually will take place will be uploaded and put where it says watch this video first. So you need to go back and watch it again. There's where it is. Okay. Over here is the note amortization calculator, which is basically this right here. So if you want to try to run an amortization schedule, you want to see what the future payout's going to be in 10 years on a note, we'll do it here. And we'll show that when we actually get to the model. I'm just going through the spreadsheet on a line-by-line basis. Okay. Down at the very bottom of the sheet, these are all the links. Here's the case study video here. I'm not going to click on all these. Here's the link to the resources. Here's the tutorial video. If you need to look up flood factor, it's right here. Everything gets put at the bottom of this. Here's the link for the download, Cash Flow Deal Machine, Be the Bank Blueprint. If you don't have the digital product, the masterclass, and you want it, you can click there to order it. If you want to learn more about our educational or our mentoring program or coaching, whatever, you want to do more deals and really understand this at a higher level, you can click on that link. You can sign up for a consultation and see if you're a good fit for what we're looking at doing. So all that stuff resides on the bottom of the model, because the modeling is the only thing that really matters in the beginning. It's the top of the funnel. It really determines whether or not it's a deal or not.
Hey, Nick, real quick, just now that we're rolling on this, the one thing that we added to here, which is if you want to do more deals with Eric and Nick, is we have a free 45-minute consultation. We'll put the link in here. So everyone that would want a free 45-minute consultation with our team, just put in there, yes, I would. And we'll also in the chat, and then also we'll put in the link to be able to do it as well. But we want to start having those conversations, because why do we want to do that? Because we want you guys to create great notes so we can come in and help. We can buy them, and or at least have you guys make sure you're not doing them incorrectly. I'll give you one call we had last week. We had someone that they were able to get pretty good financing on it, okay? And then we're going to mark it up and double their money at 5%, 6 or 7%. And we went through the model with them, and we're like, well, what happens if you have to sell that note? What happens if you have to exit out of that note and you created a 6 or 7% first lien? There's a pretty high probability they're going to have to write a check to do that, because they're looking at their spread today, not if they're had to exit out of it. And all the stuff that we're doing, I mean, people are doing 10, 15, 20% down payments and paying 10% interest to us all the time now. So just so you guys know. So that's some of the things that we're adding. I just wanted to add that to it. It's super. We really want a lot of people that are in our group. Like Nick said, we have almost 4,000 people in our Facebook group. And if you guys want a free consultation, we'll put it in the chat here. Set up a time and see if this will help you add what we do into your toolbox. That's it, right?
There's one thing I want to say, and I want to go strictly to the model, because we need the recording specifically for the model. So I'm going to say one more thing, and then we can come back to Q&A at the end. I'm fine with that. Guys, what you have to understand is this, okay? The seller financing industry, okay? All the notes, and I said this a million times, I'm going to continue to say it till people understand it. The number of notes that are written every year in the United States that aren't written by the names of Chase, Wells Fargo, Bank of America, whoever, is almost $30 billion a year. $28 billion in the last year. $28 billion. Okay? Do the math. You can figure it out. There's a crap ton of notes that will be written every single day throughout the United States, and most of them are written incorrectly. And when I don't mean they're written wrong, they're written incorrectly. Ask me how I know they're written incorrectly, because I'm a note buyer. We know what's not right. It doesn't mean it's not sellable. It's just going to be scratch and dent, and it's going to be at a discount. When you don't follow the underwriting, guys, if you're going to do this deal, if you're going to do this strategy, you got to make the commitment to do it the right way, because it's going to cost you money in the long run that you can never get back in the form of the discount. I just had a call today with the platform, and we were confirming these numbers, and they were about 83, 84% performing notes. And we're at roughly about 90% on average. Well, on a $100,000 note, which is really small these days, on a $100,000 note, the difference in money in your pocket is $7,000 to $8,000. I mean, that's significant amount of money for doing things the right way to get paid more money. And it doesn't even cost you the money most of the time. Usually the buyer's paying the underwriting. They're paying for it.
It's cash. It's money that you created out of thin air by doing it correctly. Right? That's it.
You got to pay a little bit on the front side to get the deal through, just like you got to invest in yourself, invest in your business, whatever you do to get the return back. But it comes back in 30 to 60 days. Do yourselves a favor if you're going to do it. Don't go, we talked about this, I think, on the last call where, an experienced investor wanted to go create the note himself because he thought he already had most of the work done. We spent 2 weeks cleaning up his mess. And actually, we're going to have him on a call probably in the next couple of weeks. I got to check the schedule. And we had to go back and clean up. And he did a really good job, I would say, all things considered, of writing this note. But there were still 8 or 9 things that were not done correctly. Well, if every one of those things costs you a point is 1%, basically the thing, that's 8-point deduction just for one little bitty thing. So, I said, next time, let us manage the transaction, not because we're trying to make money on it, because we want you guys to do it right. Because if we do it right, then we can come in and buy it. And if we don't buy it, we have plenty of institutions, funds, banks, high net worth individuals that will take these assets because they trust what we do and how we structure the deal. Okay, so that's all I would say. When I say write a first and a second note, I mean write a first and a second note. I don't care if it's for freaking $1,000. It doesn't matter. Write it because there's a specific reason why it's there. Because more than likely, if you don't, you're going to lose it. You will lose it in the form of the discount. So
Nick, you wrote notes right, didn't do a first and second. You just did the first, and that was a 6 million. We figured it out. Just in it was a small number of loans that you did, which, I mean, it's hundreds, but small amount in the grand scheme of things for your business. And we had calculated it was a $6 million worth of money that you left on the table. That's why we're doing this right.
That's only part of it, right? Because let's look at this right here. You say $6 million was the face value.
No, okay. I know.
That's the face value. Let me show you this. If the rate, I think we were writing probably 9.5 back then. So
we didn't include the amortization that you would have made.
This is over 30 years. Over 30 years, it's $18 million. Because it's not that's just the face value. The $6 million is the face value. The $100,000 is the face value. Because when you write even when you're carrying a small $25,000, $30,000, $50,000 second note,
or Nick,
way more than that.
Or a $10,000 site. They're like, oh, it's just 10 grand.
Look, if this is 10,000, no, it's not though.
It'll be 90. It'll be all your payments.
Let's make more realistic right here.
Do the real math. This is why we get so excited about this.
$10,000 is worth 30,000. So why would you give it away?
So what is it? But what is it in 10 years? What's the payoff in income in 10 years? That's what I was like. I love that. That's my favorite part.
All right, let's go out 10 years.
85, 120. Well, that's 120. That's 10,000.
This is just a small $10,000 second note. Okay.
So go to 120. The payoff in 120 is 9,000 plus the payments is 10,200, right?
Yeah.
Okay. So it's double. You're leaving double your money on the table by just a $10,000.
These guys add up. I'm telling you, they add up. And I don't even know if there's any $10,000 second notes out there, to be quite honest with you.
When you're a note creator, you and I just talked about this. Why not just have one? I mean, why not? You're already doing it.
100%. All right. So let's go back. I'm going to switch back to the model. I'm going to start at no more questions except model stuff. So people can go back and review this, and then we can go back and answer any questions after the fact. So you download. So the first thing you're going to do is download the model, and you're going to rename it. Okay. Save it on your G Drive. If you don't have G Drive, Google's free. If you're going to do deals with us, you have to use G Drive because we're not using Dropbox. I'm not using whatever Microsoft One boxes or whatever it is, because I want to be able to see it and use it for a very specific reason. It's the way our documents are archived. It's the way we transfer documents. It's the way we share documents, the whole 9 yards. So first thing you want to do, okay, is you're going to go down to the master, okay? You're going to click on this little down arrow and you're going to do duplicate, okay? Then it's going to make a copy of it right here. Follow me? Then the next thing you want to do is you're going to rename it, and we're going to rename it the name of whatever property. So I'm going to do one I just did just because it's fresh in my mind, and it was on a street called, McClarty. Okay, McClarty. Okay. Trying to remember the name of it. Okay, and now I save it. Okay, so that's it. Now I know. Now I can mess around with. Don't do anything before you make a copy of the master, because if you do it and you screw up the formula, it's on you. Because this, I can't control what you guys do with it. And if you find something that doesn't look right or whatever, just go back to the master and make it again. Okay. The example that's in here is an example that's there. You can go look at that, and it's part of what the video I think is on, but we're going to actually do another version of it live right now. Okay. So first thing I'm going to do up here, I'm going to show you how quick this is first. So I'm going to put the address in. Actually, it's 3710. And put this in here real quick. Always put the full address in here. Okay. I could type. I'm trying to type here. Okay. Put the full address, city. I hate this keyboard for this, but Dallas, Texas, 75241. Because I don't know if it's Dallas. I don't know if it's Houston. I don't know if it's St. Louis. Put it in there. Okay. Acquisition price on here was, I think, 187. Oh, guys, this is the great part about this deal. They got this from a wholesaler. They couldn't sell it because they just couldn't. That's why we got it. Never saw this house, never touched it. I found a buyer, and I'm going to run through these action numbers here. I think the final sale price number was 235, and I think the down payment, the other yellow box, I'm only filling in yellows, I think it was 25,000. We made a couple modifications on it. I did 0 repairs. Okay. Comp on this, I'll just pull it up right here. Here's Zillow, 251,400. Oh yeah, let's look at these pictures. This was a remodel about 2 years ago. The tenants trashed the house, cosmetically trashed it. It was just garbage. So you could see these pictures right here. This is what it looked like just 2 years ago. Okay. They can't really mess it up too bad in 2 years. It's still the same. Why am I not able to move that over? I guess I can't do it. There's a kitchen, the
arrows on the right. Arrows on the right.
What's that? Yeah, but I don't have the
arrows on the right.
Oh, it was under my things. There it is. So I mean, look at this thing, man. So that's why Zillow had it.
Nick, when you see these, you don't even wait. You just boom. You just do it.
There was no reason. Exactly. Well, if I didn't get sidetracked on it, we would already be done with the analysis. All right. So I'm going to fill out the rest of this. So 252. The rent value is 8. I go in here to go to rent value. Go up to rent value, which is I use rental meter, but I think here's I guess I closed the file. I guess I already closed it. Is it under Zillow? Sometimes Zillow. Oh, can't go back. Here it is. Let's see if I can go back. Sometimes Zillow shows rent value.
It has rent. Sometimes it shows rent's estimate.
Sometimes they do. I already did it. I'm not going to waste time doing it. It was $1,800, which seemed a little low, but that's what it was. It's not that low. So let's go to ZH. So then I want to know what the ZHVI is. So I'm going to go up here, and I'm just going to go into Zillow again.
So let's explain for the new listeners what ZHVI is.
So it's a Zillow Home Value Index and the zip code. Okay. So
and you put the zip code in, and then you don't put the address in, you put ZHVI and the zip code, and it pops out what it is at the top.
So here it is. All I'm doing is doing checks and balances here. So right now, it's got a 235,916 with a 30% increase over the last year. Okay. What does that mean? Well, it means whatever you want it to mean. But for me, I'm just going to put it in here so I have it. So the ZHVI was 235 and the index was 30%. Okay.
So could you sell for 15 grand? Could you do seller financing for an extra 15 grand in this market?
Well, that's just look. First of all, that's just the index. That's all
Right.
that is.
Right.
It just means there's probably a house in that neighborhood that's $500,000.
Yeah.
It's just the median endpoint, median price point. Okay, so we're good here. 252. We're right in line on this already all day long. And then I always default to a 60-day. I always default at a 60-day disposition. Okay, especially if I'm not doing rehab. So I just put in around 60 days. Okay, because that's going to calculate the cost of the money. Okay, that's it. I'm done. All I got to do now is scroll down, and it tells me. Let's see here. 235, 187. Make sure I didn't forget something up here. 72. I think, oh, I know what it was. This was actually 35 down, and this was 240-ish. And let's see where this is. So, oh, something's not calculating right. Let's see. What's
$35.
Oh, 35,000. That's what it was. That'd be nice for them. Okay. So in this model, okay, why is it 120? Okay, I know why. This, let's see here. I must have put something wrong in here. Oh, this is not what's 167. I think it's 167.
That's your buy price.
Yeah. So right now, based on this, let's just look and see what it says. Okay. I like to see minimum $3,000. Well, this is negative $3,700, but that doesn't mean it cost me $3,700. It just means I got to invest $3,700 to get the second note back. Okay, which is $32,500. The other thing I already know is that this is the default is at 72 and 88%. Okay, that's what I'm trying to model at, but I know that these are extremely conservative numbers. This could be,
the LTV is 72 is probably in line right now because of the market. Yeah. Is the market going to change or whatever? You went to 90, you're in business. Look at that. 300.
That's what we're going to sell for. So this is exactly what happened. So this deal, okay, I made zero money on, but I'm going to actually end up taking a $32,200 second lien position as the profit. Okay. Now let's just say for sake of argument, okay, that, well, I can't do this for free. Well, then all you have to do is come up here and you have to adjust your acquisition price to whatever makes you when you negotiate.
I don't want to do anything without a net 5K or something.
You know, exactly. You want to make net 5K
just to pay my overhead expenses. You know, you're doing 1 week, it's 20 grand a month.
Right. So you got to put in. Now, if I offer 160, now what does it get me? It gets me to $7,000, right? Okay. Net cash. Okay.
And a $32,000 second lien.
The other thing, remember, this is a forecasting model. Okay. This is not the actual. Okay. So when I modeled this out initially, I was thinking I was going to sell it at 250. Okay. And my buy price was going to be, I think it was 170. I think it's what I modeled it originally. Because remember, the forecast is different than the actual.
So what the one you just did is the actual. This is going. Yeah,
so this was what I was. So when I forecasted it out, it was closer to this, which showed me the making 2645. Okay. Okay, cash. But when I went to reality and I found the buyer, that's why you got to have. So this said green light, move on forward. Well, what I end up happening is I end up having to take less money for the property, okay, which made my profit down. I got a little bit better better price on the buy side, okay, and I was okay because I already had the answer to the question because this is the actual now. See what I'm saying? So I was perfectly okay with rewriting this deal because I already had the buyer. But you don't know what your buyer's going to give. I mean, what if this buyer that I got up here only gave me $25,000, for example? Okay, now we got a decision to make. Nothing else changes. These are the numbers. Now I got to write a check for $10,000 here.
But
okay?
but what your second lien went up.
went up to $42,000.
So would you invest 10 to make 42 plus the amortization plus?
Yeah.
That's up to you. That's you as the investor, right?
Yeah. So let's just figure out what the return is. I'm an investor basically at this time. Now, look, you can go borrow private money and put somebody in a junior lien position for $10,000, paying whatever you want. But let's
give them a 36-month payment. You got all your money back, plus give them a few points, and you're all good to go. Because now you stop $42,000, and you're
let's just figure out what the yield is on this thing. So I'm going to take $363 a month times 12 months, and I'm going to divide it by the investment.
42%.
42%. Is that a good return or bad return? I don't know.
I think you could get it better.
Depends on depends on what you're investing in. It could be good or bad.
I'm just kidding.
It could be good or bad. If you're in crypto, it's a great return. I think. I don't own crypto. I don't know. Well, that's it. So how many people, but you got to have $10,000 to do this, right?
Call your stockbroker up and ask him, if you give him 10 grand today, can he get you 42% over the next 12 months?
Secured. Has to be secured though, right? There's got to be something of substance that protects my investment, because that's exactly what we have here in the form of the house, right? The house protects our investment. That's it. Okay. That's it. So don't get too carried away. What I would love to see $3,000 cash, but where I'm going with this is, because this ratio is changing, what's going to happen if you want to be able to do more deals, you're going to have to take less cash and bigger second notes. Okay. And the reason being is the value of the properties are changing. So as a note buyer, they're looking at the investment to value. So if you look at this, we're going to focus on these numbers up here, right here. I'm going to focus on this little gray box up here. Okay. Right now, if I'm a note investor or note buyer, if I can buy $172,800 first lien for $155,000, okay, which is basically 90%. But the value of the property doesn't change. It's still 240 or 250, whatever it is. But the reason why we want to go to this lower percentage, because let's just say somebody comes in and says, well, that house is only worth 235. Well, I've already adjusted by lowering this percentage down, so I don't have to take a bigger discount on the note. I've already built it in here. Because if I would have wrote, let's just say, for example, that he only wants to pay 155. Let's just use that a number. And I wrote that first note at 75%. Let's see what happens to this note here. It goes to 162. So if they assess risk and I say, I'm only paying you 155 because I think it's down, you got to give an extra $7,000 discount. So the question becomes, do I want to roll the dice and see if I can get him to buy that? Okay. Or I'm going to buy it. Or would I rather be a little safer and say, you know what? I'm just going to write this a little bit smaller so I can hedge my bet. Because what happens, it just goes to the second note. See what happened? I'm going to change this number again.
You didn't lose the money. It just went to your second lien.
Just shifted from cash to cash flow. Okay.
So when you sell a fix and flip, a wholesale property, and you give a discount, what happens to that money? It's gone.
It's gone forever.
Gone. This is not gone. We just moved it. Now you get paid on that, And
so it's a better deal because you're getting 10% on it anyway, amortized, right? So you're just shifting it over. But what it's allowing you to do is we're able to get a higher value on that, because if this, let's just say for sake of argument, we could write it at 65%. Okay. Well, now that makes even a better investment for the note buyer, because now they're only risking 140, but the property value hasn't changed. So let me ask you a question. If you're going to buy a note for $140,000, okay, and the property is worth $240,000, do you feel pretty confident that your investment's protected if you have the house as collateral?
And Nick, well, maybe you go up and do 92%, see what happens.
Well, that could change too, right? Now, it isn't linear, right? So you can't drop this down to 55% and say, well, I'll sell that for 105%. Doesn't work that way, right? but you might be able to squeeze maybe another point or two out of it, maybe get 92. It's a lot of it's going to have to do with where's the property located, how strong is the borrower, what's the file look like, what's the true value of the asset, a lot
down payment, all of it,
the condition of the house, things like that. But let me put this back to, if we go to 65, there you have it. You maybe get a little bit more in the notes.
But you got a $59,000 second lien. So at 500 grand, 500.
I like this number to be around 3-to-1 ratio. It doesn't mean anything. There's no significance to it. If I'm going to invest 22,000, I like my second lien to be about 3-to-1. Okay. Really what it boils down to is really this number right here. Am I getting a decent return on it? That's one thing. And also, how many months is it going to take me to get my money back, right? How many months? So right here, it's already in here. It's 44 months.
Yeah. Some people like say, okay, if I'm going to max out, because keep in mind, Nick and I do a lot of these. So if I have to write a check for one, I know I'm going to get it back on some other deal. So over a 12-month period, my net cash is going to be significant. Okay. But if it's a 43-monther, I'm going to go retrade to get to 36 months absolute maximum. I know, Nick, you probably wouldn't do it for more than 12 to 24 max because you don't have
because I can take, the reason being is because if I tie up this cash, okay, it's less deals that I can do. Okay. Right. I know that I can make a better return than this 27% because of velocity of capital. But if somebody's working and they don't have any place else to put their money, or they have private money or friends and family money, there's nothing wrong with that. You can leverage that thing and do the same thing. So
you're retired and you're like, I'll put up 22 grand to get 500 a month. Like, where else am I going to put my money and make 27% of my money? You know what I mean? Like,
exactly.
And have the security that it's tied to an asset that has been underwritten properly, down payment, good borrower, and by the way, real estate investor like us, that would be the second lead. But it's like a triple threat or quadruple threat, to be honest.
Yeah, well, I can tell you, if you don't follow the protocol, you have to get this 92%. If anybody that's ever bought a note or tried to sell a note, they'll understand exactly what I'm talking about. You're not going to get this if you write this note ratio at 85%, okay? You're not going to get it if you write it at 90% first lien. Too much risk.
Just stick to what we're talking about, and you're going to be fine.
Yes, that's why you have these check sheets.
Don't try to make it a deal when it's not. Okay.
I'm much more concerned about these bottom two greens than I am this top green.
Yeah.
Okay. This tells me exactly what my net cash and second lien value is. That's above 25. So I know that's a good thing. It's at 35. My minimum profit per day comes out to be 570 a day. And look, guys, this is just a calculation. It's not even taking into consideration the amortization. Think about this for a second. This is really important. Right now in this model, it says my return is 18.9 months. So call it 19 months. But I'm investing $6,800 to generate a $42,000 second lien, $363 a month. So if I take 363 times 18.9, that'll give me this 68 number. But here's the thing, guys. This is what you can't show in the spreadsheet. Okay. In 19 months, I get all of my, let's just go put this in there. It's 42,200. Let's go back to the note real quick. 42,200. Let me show you why this is hard to explain. 42,200, remind me to go back to the rates when we're done. 9.75. Okay. Should be 362.56, 363, right? So I said 19 months, right? So let's go to 19 months on here. In 19 months, I've got all my money back, and now I'm getting this 363 free and clear, right? I have no cost basis anymore, okay? So in 19 months, I'm still owed $41,797. And
so what's your return on that? It's infinite at that point.
Well, yeah. So that's what I'm saying. You can't really, even though the model says 18.9%. It's really, really better than that, because that would be if you're getting all your money back and you had no other back end value out of it, right? You got another 360, you have another 300.
You have no leverage, and you have no leverage. So someone was saying they bring up the inflation side of it. Well, what about inflation? Well, you have no cost, and someone just gave you a coupon for $41,000.
If you're willing to wait, in this example, 19 months. That's it. So you got to have the 6,000 to do it. Okay. So guys, because I get this question all the time. I keep seeing a negative number. Well, that's not the cost. That's just your investment to do this. We love to be able to see. Before, it was easier to get cash now, cash flow, and cash later. But that was when we were running this number at 76%, because we could wait 3 months and the value of the property would go up. So the investment, the value would shift, right? Before, I could say, you know what? We might be pushing to think back 1 year ago. Okay. I do this same deal right here. Go back 2 years. 2 years ago, and then a year later, that 240 is, well, look, we already know the number. Well, we already showed it. Where was it up here? It was on, did we already get rid of it? Where's the Zillow? Here it is, 30%. So basically what they're saying, that a year ago, if you take, 235, divide that by 0.3, other way around, I mean, it was what is it, $50,000 or $60,000 increase, right? So think about it. So a year ago, I did this deal, and the value of that property was only $175,000. Just by waiting, the value goes up on the property. Guess what that does to the investment, to the note buyer? It gives them a much better position, because he still paid the $150, but now the value keeps going up and going up and going up. But what's going to happen now, values are not going to continue to go up, at least at the rates they were. They're going to be a lot more unpredictable on how much they will go up or go down. So we're hedging our bets in a way by creating a smaller ratio on the first note. There's nothing that says that you can't come in here and write this at 75, okay? But I will tell you, by doing that, you're running the risk that you may have to, what's going to happen. So let's look at this right here. Let's look at the second note again, okay? I wrote a 75% first. It went down to 35,000, okay? Go back to the 72. It should go back up to the 42,000. $7,000 difference in value on the second note, okay? So unless you know from beyond a shadow of a doubt that you're going to get this number right here, this combination right here, don't write it for the higher number, because unless you can get a buyer to commit to it and give you a bid or an offer on it before you say yes to the borrower, it's just not feasible and practical. You're better. My position, I'm just telling you what I would do. I'm going to write this note. I'm going to write a second note all day long that's bigger, a smaller first, and I'm just going to wait to get paid on it. Because if I can afford it, I'm getting 10% and it's amortized, and I'm getting it paid back in 19 months. So let's talk about the changes in the model, and then we can open it up some Q&A. Okay, so a couple of the changes. Let's go around here. So first change is I defaulted this to 60 days. I'm going to recommend that we go the 75 days, okay? Give or take. It's just a number. It's just a number. Doesn't mean anything other than the fact that it's taking the consideration if you're using hard money, they're going to figure out the longer holding cost, which is going to affect your cost, your profitability on the deal. That's number one. Okay. Number two, I changed it from 72 instead of 75. I'm changing from 90 to 88. Okay. There's a lot of uncertainty right now in the market, and we just don't have enough details yet. If it starts stabilizing and look, we went through the same thing when COVID first hit, right? What happened in COVID? Everybody freaked out, and the market went sideways and backwards for about 2 weeks. And then all of a sudden it went up 10 times. Who would ever thought that? So we don't know what all this is going to do. And it's also very, very, very market specific. Not only is it market specific, it's also zip code and neighborhood specific. So don't necessarily put all your value or understanding into the what the news says, or when I post things, you really need to break it down a little more granular relative to your own area or where that property is, because Dallas is not Houston, is not Little Rock, is not Memphis, is not St. Louis. They're all different, but the national averages will lump everything under one umbrella. Okay. The last two changes on here, remember before, I think the old model showed 9.5 and 10.5 on the first and the second. I went ahead and I put it both at 9.75 on both. Okay. We're trying to keep the affordability in play.
Yeah, that's what I was going to say. I mean, we got to make sure that when people qualify and put their down payment, they can actually show the affordability at what we want it to be.
Yeah. The next logical move from this number right here. Now, remember, you need to now this is everybody needs to verify what they can charge. If there's any usury laws in your area, you know, the service, the underwriter should be able to help you with that when the borrower goes to underwriting. So should the transaction coordinator. But I'm writing it. The next logical step is probably 9.95 for the first and second. And then if it goes any
Nick, real quick on that,
yeah.
What's the note? What's the first and second value on both those combined? On this one, you
got to go up here and add it up.
Was it 240? No.
Well, the sale price was 240, 25 down, 42 and 172. So is that 215?
Okay. So one of the things we were talking about with our group yesterday, or I guess it was last week, you know, just like
before you go there, let's finish the model,
because
I don't want to lose track of that, and we can get back to that. Okay. So I think that pretty much covers all the edits and changes in the model. Okay. I think we're good there. Hope this helps you out. Go back and watch this video. Make sure you duplicate the master, save it, and go through it. And that's it. You know, these aren't hard, fast numbers. These are just what I see. This is what I'm doing my deals at right now. Okay. And quite honest with you, I don't need as much cash. I'm more willing to make this even lower to get me more on the back end, because I want the paper. I want to hold it. But you know, you got to make money, right? You got to get, sometimes you need some cash, but what I don't want you guys to do is go manipulating these other numbers. If the sales price is a sales price based on value, leave it there. Don't adjust. I think I put it in here. Did I put it in here? I would say when you're modeling this out, real important, do not model this at more than 10% from the down payment from the borrower. Okay. Do not model it more than 10%. You can ask for more money on the down payment and you may get it, but when you model it conservatively. Okay. So 10% would be, in this case, would be 24.
I mean, we had one the other day where the guy wanted 30. I asked him for more and he said he could put up 50. He had the money, right?
Yes. All right. So what we'll do here is I'm gonna take this one off the screen. Hey, Elvia, did we had somebody that sent over a model? Did we not? Who was that?
Yep. Let me see.
Nick, what I wanted to say was when we were having a call, someone had a question regarding how do you come up with, because you have principal, interest, tax, insurance, and servicing, right? PITIS. How do you have a general? And we typically just take the loan amount times the total down payment, the sale minus the down payment, and the total loan amount, and it's 1%. We have because obviously in Texas taxes are a little bit higher than they are maybe in a different market. So we typically, just as a general rule of thumb, take 1% of the loan amount, and that's where you could say your payment is. But we don't know, because we don't know. Taxes can change, insurance can change.
Look, who knows what's going to happen? The value of these properties have gone up 30%. Eventually, the taxing entity will catch up. I can promise you.
Yeah.
They may not catch up this year.
And that's the greatest thing about what we do. It's very predictable because we aren't paying taxes and we aren't paying insurance. They are, and we're not paying the servicing fee. So there's never. It's more of a, like you said, like this tool in the toolbox for us is, how many of these can I do without being a landlord, you know what I'm saying? And so it's just how much time and energy do I want to put into something? Because what Nick and I know is once you create a good solid loan, there's nothing to do.
No, it's correct. So like, hey, so John, I think John has a model. So John, I'm going to give you, John, raise your hand so I can see you. John Stern. Make sure he's on. He may not. There he is. So, John, go ahead and unmute him and unmute yourself, and let's see, make sure what he's got, and then we make sure. I want to get some questions, but I want to get John prepped on his side. John, do you have the model? I'm going to give you. I want you to do this. Basically, I want to walk you through it and make sure that it's there. Do you have your model available to share?
Yes, I do.
All right, well, you get your model ready to share, and then let's go, and Eric, let's go through and answer some questions while John's getting that ready to go, so we can be fluid in doing what we're going to do. So what questions do we have? Do we get them all answered in the chat, or do we need to, let's see what we got here. Let's see, chat.
Nick, do I just share the screen, or
I'll give it. I got to give you control real quick. Go ahead. All right. Okay. So you have screen share, and then you should be able to click on that spreadsheet when you go to share screen. So we're going to walk through this real quick, and we're going to start at the top, and then we're going to say what you did or didn't do. So, okay, great. So you already renamed it. That's good.
Try to make it a little bit bigger on your, maybe add it.
I think it's plenty big enough.
Can you guys see it? Okay.
Yeah, I can see it fine.
All right.
Yeah, you can make it a little bigger. That's fine. Yeah, good. All right. So you got the address in here. You did all this stuff. You got the down payment. So you got all this in here. So this looks, so you got a repair in here. So let's talk about that. Okay. On what that looks like. So you filled this all out. Scroll down. Let me see the bottom of it real quick, John. Let's go to those three. So right here, it says $31,000 out of pocket. $22,000 is the net cash value. $120 minimum per day. Okay. So there's a couple things.
Let me do one thing here, Nick. Let me back up. I did this. That's the rehab. This is the as is.
All right, good. Yeah. I didn't like
so let's start with that.
Well, we'll look at them both because I think this is really good visually to see why we don't do rehabs. Okay. Okay. So now let's see where this one is. Okay. So you've got 2,000 in rehab. What is that for? Like paint and carpet or something? Clean up?
Basically clean up, clean out.
Gotcha. Okay. So you got 28,000. Now, personally, what I like to do is you want to have a minimum of 8% down payment minimum. So I may change that a little bit. If I'll negotiate that with the buyer. If the house needs a little bit more work, for example, we want them to do it. We want to trade that away from us. Okay, so let's go down.
And then, but Nick, for some of the people new on the call, we don't trade dollar for dollar. We trade material dollars, not labor. We let the sweat equity pay for the sweat equity. So if it's a $35,000 rehab with $20,000 or $15,000 in material, that's all we give them. We give them 15 grand in material costs, and then they do their sweat equity themselves.
So let's ask John. So how did you determine the sales price, John, versus what the value of it is after repair?
Well, to back up just what Eric said here, I did this in the orange box.
Yeah.
I figured $25 a square foot. So I had a $34,000 rehab, and I gave 50% of that. I was figuring a rehab ARV at $295, so I came up with a sales price of $283.
And $283 is right in line
exactly what Eric just said,
which is right in line with what your comps say, right? So so everything I like about this so far, it's below the median home price on a Zillow value, right? Why is that important? Well, it's important in my opinion because if that's a desirable place to live, and somebody can get in there below the median price, that's a good deal for somebody.
And
Maybe
throw some sweat equity in there. And now all of a sudden they've given a down payment and they have equity and they have more of a chance to make that payment.
Yes. So let's go there. So I like everything I'm seeing now. All right. So now let's scroll down to the bottom and see what your numbers are now. So you got so it's costing you $980 for a $51,000 note. So let's just toggle back and forth between these two. Let's not do anything else. So option one is to do nothing and invest $980 to get a $51,000 second note. Option one, right? Show us option two, the rehab. Or option two is invest $31,876 to generate a $54,000 second.
Oh, and estimated 184 days to freaking do that.
Yeah.
Yeah.
So let's talk about this for 1 second. Let's just say you had all the cash yourself to do this deal, right? Well, if you look at this based on the number of deals you could do a year, you could basically do 2. Right? That's it. Okay. Go back to the other screen. The last one. Here, you could flip your money, you could flip through your money, where you're almost positive you're going to get all your money back in 2 months. You're not going to run out of capital very fast if you're only in these deals for 2 months. Okay. So now let's just go up and look through this here. So what questions do you have relative to whether or not this is a deal? What are you thinking? What's your thoughts on this? Like, where is this located? North Carolina? We're in North Carolina.
Yeah. Benson, North Carolina.
Which is where?
We're about 30 miles southeast of Raleigh.
Okay, so it's a suburb of Raleigh.
That's a great. That's almost metro.
And are you familiar?
This is the house.
How are you taking this down anyway, John? If do you already have this contracted?
I do not know. This where I can't. Crap. How do I get back now?
What are you trying to do?
It's
there's an X in the right.
I just wanted,
just X out of it. Yeah,
there I found it. So that was the house, and this was really bread and butter for what I'm looking for: a 3-2 vinyl sided, single family home. And then I figured this one for the comp. There's a. Oh yeah. Okay. Now I see.
Good looking little house.
That's what yours is going to look like when they're done with it.
Right. This would be the comp. I've done stuff like this before. Laminate tops, not granite.
Yeah, it's got white appliances, laminate tops. I mean, this isn't even this isn't even a remodel.
Yeah, this is and this sold for $285 a couple of months ago.
Yeah, it was in a peak of the market, but it's okay. Doesn't matter. We're providing seller financing.
Where I originally struggled was getting the ARV. I was initially looking at this at 265, and nothing was. When I say pencil out, trying to be cash neutral.
Well, let's just go put 265 in there for a second. Let's just change the sales price to 265 and look at what it changes to, and let's figure out what that looks like. Okay, so now the second lien went up. You're at $11,000 now. Assuming you could afford to invest $11,000 in this deal, would this be a good return? Would you invest $11,600 in it for $46,000 in a second house?
Still only 20. It's only 27 months, 28 months to get your money back.
397 times 12. Let me see what the yield is on that money that you're investing. Divide that by 11,665. That's a 41% return while your money is out.
Right.
Not bad.
Yeah. Yeah.
Okay.
No,
go ahead.
My struggle is on cash poor, equity rich. Have the equity to take this down. But my initial goal is to
let me ask you a question.
What do you mean by equity? Like, what, you have a few houses free and clear, or what?
Yeah. I've got a credit line on 2 rentals. and an equity
Well,
a
let's,
HELOC on another.
Well, when you say credit
Okay.
line, are they open?
Yeah,
So then
Look.
you are credit, so you are cash poor because you can use
no,
your
but
credit line.
let
to
me
go do
ask
the
you a question. There's people in this group right now. How many people would do would invest in a lean position to get a 20% return in scroll up? Like you got the control. Was it how many months was this? 30 months. So a 3-year note paying you 20%. How many people would do that on this deal? Because you have to use your own money. You just go borrow $11,665 and pay them the return. You don't have to give it all to them if you don't want to. You can just give them 20. I'll pay you 20%. Look, if you paid somebody 20%.
Well, if you did the 20%, but I'm just saying at 10%.
I would, that's not my, I get it. I know what logic says. You're missing my point. Okay. The point that I'm trying to make, could you do this deal paying somebody 20%? Yes or no? You would run, not walk, because even if you gave them the whole 40% and you just sat on this deal waiting for the 29 months to clear, you get all of you get it all.
So
Yeah,
basically,
a light kind of just went off. This is the creative side of doing this thing.
so think about John at 11,000, 20% interest, 4 years is still less than $390. It's $334 a month.
Yeah, so you're still getting some positive cash flow on that deal.
Yeah, whatever. But you would just match it up to the exact number, and then in 3 years and 7 months, that money comes to you. They're paid off, and now you get all the money. And we know that the $46,000 note is going to be $45,000.
That's it. So John, let's look at this real quick. Let's use $46,200 and 9.95. Go up to the top of the spreadsheet. Click on the note amortization schedule. Let's just walk through this and see it. Okay. Let's click on this. Okay. So,
by the way, you guys, the Note Unlimited spreadsheet that we're talking about here is free. The link that we have is free. You don't have to buy it and put all your notes in there. You don't have to.
Go ahead and just here it goes. So go put 46,000. Was it 46,200?
Yeah,
that it was 46,200. 9.75%. Okay. Solve for the dollar. Okay. Okay. And how much cash did we need? It was
11,000.
But now how many months was it? I'm sorry, 29 months.
30. Yeah, 30.
Oh, at 30 months. Okay. So what I'm saying here is that you have no money. Okay, John, and you need $12,000 to do this deal. Okay. Right. And you bring in a financial partner to do this. Okay. And you say, I'm going to give you, you're going to get a 40% return because you're going to get all your money back, or you do what you can figure this out. But I'm just going to say worst case scenario. I'm going to give you $396.93 a month for the next 30 months. Okay. Right. You're going to get whatever that turns out to be. You can, what does that come out to be?
So you can even go here, give me 15,000, 20% interest, 5 years is basically 397. It's the same number. You can actually make $4 grand on the deal if you want.
I understand that. I get all the negotiation side of it. You're missing my point. Okay. We got to make it. You can negotiate whatever you want. I'm just trying to show the break even part of this. Okay. Let me finish this. Go through this, John. You're going to give away everything because that's what we do. Okay. And now in 30 months, you paid off your debt, right? You sold the first note, that debt's gone. You paid off the $12,000, that debt's gone. Okay. 30 months, scroll down your amortization table to month 30. Just scroll on the right side, side.
Oh, I'm sorry.
Yeah. It's okay. Go down to month 30. Okay. So by you waiting 30 months, you can cost you a nickel. You leveraged everything. And now you're still left with a $45,000, $471 note. Okay. Follow me?
Yes.
And you still get all. So from month 30 through 360, 330 months potentially on paper, you will make another $396 a month. Okay. Negotiate all you want on the front side. I don't care. Knock yourself out.
So Nick, so it's a 30-month partial for this amount of money with this return. And so that's what you do. You create a partial. Someone asked, Gretchen asked, who handles that? It's all done in servicing. And so once it's done in servicing and it's paid off, a note is instructed to go back to you, and then you get all the payments. That's how it works.
Okay.
Yeah.
Yep.
You know, exactly. So what will happen is you'll have a private money guy involved. He'll be a part of the deal. And then you're basically you're gonna basically pledge all the proceeds.
Or she.
Or it or they. I don't want to discriminate. Whoever it is or they are. And just whatever you negotiate. You might say, you know, you can do the partial model and say, look, I'll give you $395 a month for the next 15 months.
Yeah.
20 months. You can negotiate that. I'm just saying it has to be at least it can't be worse than this. Right?
And guess what? It's secured to valuable Benson, North Carolina real estate.
You got the asset because somebody is going to lend that money is going to show up.
Yep.
Basically, you know, you have the second lien. You also have the second lien as you can collateralize that too, or pledge that as collateral as well. So I'm just curious if John went out and did this deal, I'm going to say 40%, John, because I'm nice and I'm nice with your money.
You're giving up John's money here. Stop it.
Saying, all right, let's be a little conservative. Who would do this deal at 15 to 20% based on this deal? Who would, if assuming you had $12,000 to lend, would you lend this money out for call it 2.5 years for a 15 to 20% return on your investment, secured by the asset? Would you do that?
The chat's blowing up. Look at that. Look at all those hard money lenders. They would love to get a 20% return.
Why wouldn't they?
Yeah.
100%.
And guess what? They know that note's written properly and that it's all done on the front end the right way because of what we're talking about.
100%.
So just how much better.
100%.
So guys, this is the creative side of what you're doing when you see that negative or that investment. I know Nick keeps going back. That's an investment. It's not a cost. This is the creative side of doing deals without money out of your pocket.
Yeah, absolutely.
All right.
Okay.
The question is, if you had the money, the question is, if you had the money, would you just let it ride or would you still go borrow? It's a good question. Don't know.
So there's a lot of investors. There's a lot of investors that look at this deal and their job is to go find a house and sell it on terms and then get a private lender in place on a partial or however they structure it. And put zero of their own money because they're putting all of their money and time into the deals and finding deals and finding buyers. And then they're just scaling it up. So they're never worried. They're not worried about the money because they know they're always going to be able to fund the negative side of this. I mean, geez, like in this market, realistically, anything 20,000 and under, you should probably take down and do if the asset makes sense and the borrower put enough into it. That's my opinion.
Yeah. So Zach had a great point. He goes 12 to 15 was probably easier to raise than 40, 100%. Because you make these offers too good to be true, then people think that they think it's too good to be true. Then you're probably not going to. So they're going, why would you?
But
I can't get 40% investing in the coal mines of Brazil.
This isn't a personal loan. You're securing it to the property. So it is what it is. But he's right. But you're an investor. Yeah. You're an investor.
But you know what? Honestly, with inflation and where things are going, I think you could go find private money all day long at somewhere between 8 and 12% for 30-year loan.
In second position on a parcel for sure. You could. And then you just pay them off, you just front load it. So they're not out 30 years. They're out 3 to 5 to 7 years, whatever.
You put that private money in the second lien position and you go into the third position.
Yeah.
What I would do. Because once they paid off, it doesn't matter.
And like I said before, instead of borrowing 11, borrow 15. Put 4 in your pocket.
That's another point.
So you can go. So you actually do get paid for the deal, and then you invest that money to go do other deals.
So let's just take that into consideration for a second. So scroll up for a second. Go back to the model, the calculator real quick. Actually, no. Go back to the spreadsheet. I'll show you where to put it. So what I would do is I would come up here where it says assignment fee. And say you wanted to make $5,000 up front, put $5,000 in there. Okay. Now
Hey, remind us to talk about hypothecate versus partial, because someone had a question. I just wanted to compare the two.
Scroll down now, John, and let's look at your cat. Now your minus 16,000. Now your ROI went up to 42 months. Okay. So same question. Would you give up the next 42 months of payments to get $5,000 today? Go back to your amortization schedule. Let's go back because it didn't change. It's not going to change much. Okay. Go back before you change it. Okay. Scroll down. So what's the difference between month 42 is 45,126 and go back up to 30. Because that's what you're going to get. That's your back end bill. 45,000. It's what is it? Not even $500? I mean, Jesus criminy. You hardly paid any of that down. Because guess what's not going to change? The payment you receive. Doesn't matter. All you're doing is waiting. So the question is, John, the question to John is, or anybody else, is it worth $5,000 today to give up an extra 12 months of payments?
Depends if you need the money or not.
And absolutely, everybody.
But it depends on what you're doing. Like if you're scaling this up and you want to do one a week, and you did all of them just like this, you wake up 42 months from now. Every 42 months, you're going to start getting all this cash coming in. So it's really good. Real quick. So someone, Zach said, or pledge the second lien note / hypothecate. So
right. Well, that's sort of in a way what we're doing. We're talking about, like John, John brought something else when he talked about the creative side of it. That's exactly what the academy does, right? So if you're in the academy, that's where the advanced strategies and all this stuff comes in. I mean, the model, this is just a way to the whole point of what we're doing now is just to show you how to use it. It's up to you to make a determination what is the best outcome for you personally, right? That's different. Some people say, well, shoot, I want $20,000 cash now. I'll wait 5 years. Okay. If you can go sell that and get that and that piece of it on the note on the back end, have at it. Some people might say, I'm sitting on $500,000 in my IRA account, and I'm going to try to figure out how to invest into these and take it on the back end. So everybody's situation is a little bit different, but so basically what we're doing, go back to the model real quick, John. So what we're doing is we can do this one of a couple different ways. Okay. I'm not really sure. What I would like, if this was my deal, what I would probably do is you're going to probably have to, the problem with partialing in this model, let me think about this a second.
No, you're thinking of hypothecation.
You can't partial until the first lien is paid off and gone. Okay. So once that is done and you sell it off, you can't partial. You're not going to be able to partial something and leave the debt there. So we have two different loans there. So this is really applying to the second. So it shouldn't matter. Okay. Because people will say, well, you can't have underlying debt. Well, that's true. But the underlying debt, there is no underlying debt on the second, right? The underlying debt is not there because it's free and clear, or it's $16,000 investment. So maybe what you have to do is you either have to bring an investor in the beginning, or you, as soon as you write the note, have to go sell the partial, which meaning partial payments, which is what we just talked about. We're going to sell you the next 3 years of payments for whatever the return is, or 2 years, whatever it is. And then that's how you get that $16,000 off the books. Okay.
But Nick, so real quick, I want to give you my opinion on, and I like what you just said there, because there is a transaction part. You got your hard money, and you close on it. You sell your first lien, you create the second lien, and the way you get your cash back for the 16 grand or the difference is to do a partial or a hypothecate or borrow it. Okay. What my opinion is, hypothecation, which you're leveraging that debt for 42 months or whatever, that if there is a default, you still owe that money. If you do a partial, you don't owe the money. They get the right to that note until it's paid off. Here's the best part: if let's say 3 years into the thing, out of the 42 months, the guy refinances. Well, now you only owe 16,000 less your payments, plus you get the $45,000 lump freaking windfall. That's why the partial is good. Or even if you have leverage. So I like, personally for me, I like to partial if I have a negative, if I have an out-of-pocket expense that I want to recoup, I would partial, let them run with it for a while, and then it'll automatically come back to me, versus hypothecate and leverage. Because hypothecate, yes, you might be able to get a lower interest rate. It just depends on what you want to do. But with that, if you sell the first lien, if you sell the first lien and then partial, you have no risk. You're just waiting for it to get paid off and then return.
Because the other option is that you borrow 16,000
Mm-hmm.
and you basically are arbitraging, right?
Yeah.
Which means I'm going to pay my private lender his $300 a month until my debt is satisfied, and I'm going to collect the, what was it, 396 or whatever it is.
Yeah, or just make it 400. Yeah.
I'm gonna arbitrage the deal until it's paid off, right? That's it. So either way can be done. It might depend on who your note buyer is. Honestly, my opinion is probably the opposite of Eric's. I would say I would just take the private, I would pay the private money guy a little bit more money, put him in the position in there as a short-term lender, just like a hard money lender would be, and just pay him and pay him and pay him and pay him. And it's not that big of a dollar amount.
No, but Nick, I would do exactly what you do because I can afford to pay him. So I try to get the lowest rate possible and arbitrage as much as possible. But if I'm in a position where I have no option and I want to borrow 100% plus a little extra, then I would partial it that way. That's what I was saying.
I would just borrow the money, and I would take every penny of cash that came in from the cash flow in the second and pay down the debt and get rid of it as quickly as possible. I don't care about $100 a month arbitrage, right? I would rather just pay that debt down and get rid of it, because if my buyer defaults and I'm in the second position, I still owe him money. That's the risk portion of it. That's why it's not infinite ROI until that debt is satisfied. So there's ways that we can structure, but this is stuff that you have to be in the academy to get this information, because it could be, we don't know who the lender's going to be on it. We don't know how to structure it. It's going to be, here's my point, Eric. I would much rather know that I need the $16,000 before I closed on it and go borrow it than trying to figure out how I'm going to, because you can't get the money any other way. Unless you got the $16,000 to put in and you're going to try to reimburse yourself by selling the partial. That's the only other way, because you're not going to be able to sell anything. You can't get the money before you have something to sell, right? Because remember, there's two transactions here. You're going to have the three transactions. You have the buy transaction, you have the sell transaction, and then you have the note sale transactions. You have three, and you're not going to. The $16,765 happens when you sell that. The net of that happens when you sell the note. So you're going to have at that point in time, you're going to need to have all that lined up to make it work. It's not hard. It just has to be structured accordingly. So John, I hope that answered your question, but I don't think it's that hard to go borrow $17,000 in this deal. And I would show them this. I have no problem showing people what I'm making on the deal. I want them to see exactly.
So in the chat, when you're talking to people, okay, this is what I do. What do? Well, I help people who are tired of the inconsistency of the stock market and crypto achieve above average returns on their idle money. I put idle money, while giving them valuable real estate as collateral, which is secured to the property. That's my elevator pitch. Write it down. And that's what you do, because you're out, you know how to go find houses. You know how to find buyers that need houses that aren't able to get a traditional bank financing. And then you bring other people's money in to help them do the deal. And you just kind of rinse and repeat. That's kind of if I'm out golfing or doing whatever, that's what I tell people I do. And then that opens up a whole bunch of conversations about how I do it.
John, any other questions on this? And we'll get some more Q&A and then wrap this thing up.
No, that was fantastic.
How are you planning on taking this down anyway? Are you taking it down with hard money?
Haven't decided. I think that the deal is gone. but it's been a learning experience. So this is good. I mean, the whole idea when it's actually your money at stake is a real learning experience. And then that's what's been really valuable. I'm going to follow up and see if it's still available. Because this one kind of just fell in my lap. I haven't been doing outreach to wholesalers as of yet. I was, be honest, a lot of anxiety there of reaching out and you know, here's a quick question for you. I think it might help a lot of people. If we looked at the rehab ARV of what's here now of 295, and we take 75% of that less the 35,000 in repairs, that wholesale number then is 186,250. And this would be my question: if we're coming in at an acquisition of 180, that's less than wholesale. Are you finding that to be you're able to pay more than wholesale? That's my anxiety.
Yeah, because wholesale numbers are dropping by the day.
So you're finding that
the big Wall Street buyers, and I don't sell a lot to them, but as far as I know, the networks I'm in, they're not buying anymore. So that's,
yeah, I don't think, I mean, wholesalers are coming down now where they were at 80% less repairs. Now they're 70%. Next month they'll be 65%,
which is good for us. We're just going to get better
it'll
deals.
be at 50 or 60%.
Yeah. Well,
yeah,
they were buying at 100% and selling for 110 in certain markets, but that's different. But that's just going to be so much better for us because they're master deal finders, and we just want all those deals. So whatever it is, it is.
Yeah, I mean, that was something that you harp on, is that there's zero marketing cost, and you're not dealing direct to seller. So every
deal's not going to be perfect, right? I mean, you might, because remember, this is just a forecasting model. Okay, it's all that it is. If you're able to go get an extra $5,000 down payment, what does that do to your deal, right? So, even if you came in at 186 on this, go ahead and change it to 186 real quick, and then I want to wrap this up.
Yeah,
change it to 186. Okay, let's take the 5,000 away now. It's going to almost be the same. Now go down there. Go down to the bottom. 18,000, same equation. Just a couple more months added to it, right? You would still do that deal if you just got to go get $18,000, either and get a 4-year note on it for paying whatever return. That's based on paying. That, got to remember here, this is real important. That 45 months is based on whatever that return is, and that return is what's the return now? What's the 396 times 12?
Yeah, what happened to the second lien? Go scroll up so we can see the second.
915.
The second lien's still 46,200. I mean,
so now the yield comes down to about 27%. So, but if you're only giving them 15% return, then you can figure out, you can do the math on it. Go to the calculator.
When you change that, why isn't the second lien changing? Is it because of the first lien? Why is that not adding up right?
I don't know. I didn't see his last change.
Well, it's always been 4, or maybe it was 42. So I don't know. Yeah, maybe it went up.
I think it's fine. So let's just see how many months we would have to pay. Let's go back to the note calculator real quick. We're going to use the 46. So what we're going to do is do 15%. Okay. We're going to leave the payment the same. Now solve for the number of months. Why didn't give me a solution? 15.
It's because it's got the 46,200. He's got to put the 17,000 in there.
Oh, that's why. Yeah. Put the 7.
Just put 18,000 in there. Just put
18,000. Yes. Now solve for months. How many months is it?
68.
Oh, it's because.
Oh, that's right. You went up to 15%.
Yes. So we amortize it over that 15. So if we want to, yeah, exactly. Because remember, we're paying it longer time, right?
Yeah. So, I mean, drop it to whatever. I mean, you know, it's still, just keep in mind, you're amortizing down faster on a 68-month term versus a 360-month term. So it's still your money. You're just getting free money. Every payment that's made, eventually you get it paid off, you know?
All right, cool. All right, John, let's, I'm going to wrap up. Go ahead and stop sharing. Let's get to some Q&A if we have any left. And I hope that helps out, John. And then, yeah, we'll keep us posted on that. All right, cool. Do we get all
the short answer is I would try to do that deal.
Yeah.
Why wouldn't you? Yeah, absolutely. So, all right, does anybody else have a specific question they want to ask, or did we miss anything? We're going to wrap up. If you have something.
Like I said, I put in there the 45-minute consultation. You can do that. I'm kind of scrolling through here. I think we kind of touched on most things. The cash, obviously, how to get the new updated version 3.2. That's in there. Plus, it's also in Facebook, so it'll be pinned, so you can find it. I'm just kind of scrolling through some of these questions. See that I think we answered a lot as we were going along. I think it was good.
All right, Sean's got one question. Let's go on and answer his real quick, and then we'll just wrap this up.
Okay.
All right.
Yeah, I was asking, and there was a couple of responses from members, but we were wanting what your take was. Is there a % of ARV in which this model works? So like a fix and flip, we might target a 70% of ARV minus repairs. A subject to might be an 80 or 90% of ARV, sometimes even more. What % makes this model appealing?
It's the calc. You plug it in the calculator.
Well, and also, the other answer, it depends on how you're acquiring it, right? I mean, it makes a big difference on how you're acquiring it. You know, this model is based on buying it with cash or cash equivalent, hard money. But as we move forward, and as we show in the academy, there's better ways to acquire now moving forward that isn't hard money. Hard money still works, but you're going to just have to run the calculation and see. It really boils down to how do you gap fund the deal, right? How do you gap fund it? Are you gap funding with your own cash, or are you going to borrow that gap fund? Because all three of those examples that John put up there, all three of them, they're all way worth doing it because of the value that you get with amortization and what the true value of the deal is in time. So you can only answer that because you can only determine what's a good return on your, on your capital and how much are you willing to wait. If somebody told me that I had to wait 5 years to get the back end 25 years at 10% on any amount, I'd say, where do I sign up? How many can I do? Okay, we're showing it, trying to get cash today. I'm saying I'd wait 5 years. I probably would wait 10 years if I could eliminate the risk, eliminate everything, and just wait for the back end.
But Nick, let's just say 36 months into the deal and you shorten that amortization on your private money, your gap money, and you get a lump sum payout. And like he said, it was 17,000. Well, gosh, maybe in 36 months he only owes 10, but he's owed 45,000. That's the whole point of what you're saying. How many of those would I do?
Yeah, the money doesn't go away. It just gets reduced a little bit.
Because you're front loading. You're borrowing short and lending long, which is fine, but it's getting crammed down.
Does that answer your question?
I think so. It's very, very deal specific. You almost have to run the model on it to see.
I mean, that's the whole point of doing it, because you just don't know. I mean, you just
go out and do a deal, you market for a buyer, and you start seeing what the market will bear for down payment, monthly payment, stuff like that. A lot of rural communities, we have students, and they don't even touch metros. They go outside in rural communities and they offer terms. They buy on terms and sell on terms and just wrap them up, man. It's fantastic. Yeah.
Yeah. So,
on the inflation, Peter talked about the 9.6% inflation. Yes, but are they including the amortization? Just run the amortization schedule, and then it'll outrun inflation. That's why banks do what they do. This is my opinion. What Nick and I talk about is our opinion. You guys can take whatever you want on it. But
well, it doesn't matter because we already went through the model. If at some point in the future you have a free and clear asset, I don't give a crap what inflation is.
Yeah.
Okay. Yeah. The first one that we did was 9 months, and then it went to 18 months, then it went to 30 months. Okay. If I'm leveraging that against, I'm sharing that profit or borrowing it, and I'm sitting on the sidelines for 30 months, I don't care because all I'm doing is waiting.
So if you
matter
did,
what happens.
Yeah, if you did one every 2 weeks for the next 30 months, how many 40,000s would you have free and clear by then? It just starts to, it stacks up. And so, and end result, why Nick and I do what we do, you guys are the ones, as you're learning about this, you're going to be the people in the market that offer financing to homeowners that aren't able to get traditional bank financing. And we all know statistically, when the market starts fluctuating, it's going to be harder and harder and harder for someone to get a bank loan. I mean, and our borrowers are really qualified. I mean, they're good. I mean, the guy we're doing right now, he put 50 grand down. He has a $400,000 house free and clear, but he's willing to pay us 10% interest as he works through his divorce and whatever else he's got going on in his life. It's situational and time. And so he's going to have a house for he and his kids rather than rent. And then he can afford it. So that's kind of where we're at.
You know, at the end of the day, there's one last thing I want to say on this. It just really depends on how patient and how long you're willing to wait to get paid on some of the stuff. The good news is there's going to be more deals. No question about that.
Yeah.
The bad news is if you consider it bad news, you're going to have to take less cash now and trade it for cash flow later. But you're going to get more cash later. But you're gonna get less cash now. But Nick,
but what if you
part of the deal?
But what if this business is I'm doing other things and I do one of these every 2 weeks or whatever, or once a month or whatever, and you need an extra $500 to $7,500 to pay your bills? You just add it into your gap funding, pay in better interest rate, and then a few months later.
There you go. If you need a couple of extra grand on the deal, then you're just gonna have to pay it out longer. Yeah. I think what you got to be careful though to get to answer Sean's question is I think you got to figure out where the short-term money ends, meaning where, what does that line look? I mean, I don't think there's any issue getting 3-year money at getting 8 to 10%.
Not when you share what we share, it's secure.
You push it to 10 years though, you're probably not, can you get, how much can you get if you're paying it back over 10 years, and how much is it going to cost you in inflation, right? Or in interest, right? I don't know. I don't have the answer. So you might want to, have your private lenders together. The other thing that we have available to you guys through our relationship with Private Corporate Services, they have the business credit. You guys don't have that and you haven't done it. Go book that damn free consultation call and ask them about. I think you can get $15,000 like that. Well, if you had a $15,000 business line of credit and you could use it for that deal that John just did, you don't need to go borrow private money. Just use it off the line. It's a hell of a lot cheaper. So anyway, just with that. But I think what the last thing I'll say, relative to Sean's question, for me personally, I think I would want to keep that short-term private investor money. I'd want to limit it to probably 5 years. I think that's probably what most. I mean, there's short term.
But Nick, how many deals could you do if you had 5-year gap money? I mean, Jesus, it's unbelievable.
All of them, and not costing you a penny.
Yeah.
But I mean, I think there's some lenders in here. I mean, 5 years. I'm just curious if there's anybody that lends money right now. Just throw it in the chat. If you were what would, based on where we are in the economy, inflation, interest rates, what's your comfort level from a term, right? What's your comfort level if you're going to lend out in this type of position?
Like 1, 2, 3, 4,
1, 2,
5
3,
years.
7, don't care, whatever that is. My guess is, I think 5 years is a pretty safe time. I think you can go borrow money for 5 years in that 8 to 10% fairly easily. If you start saying I need 10-year money, you know, you can have less people
I
that are gonna raise.
I have private investors that I work with. Some of my best lenders, they're financial advisors. They've made all their money. They're just getting paid their 1 or 2 points off their portfolio. And I have some of my bigger lenders. They have so much cash right now. So I'm giving them 7. They're financial advisors, and they love deeds of trust.
Well, what term are you giving them on that right
7 and 5, 7%, 5 years. That's it.
now? Is that something that's happened in the last 30 to 60 days, or is that older?
It's a little bit older, but it still applies. I mean, because
No, I know, but I'm saying there could be a rate adjustment because inflation, right? There could be a term adjustment because of inflation.
They're not complaining about their check and their
But
money.
the thing that we have, no, but the thing that we have in our favor is that what is their alternative?
The people that I don't focus on real estate investors and note buyers. I focus on people that want to preserve capital and get a fair rate of return. That's 7 times the savings account. That's what I do.
So Stacy chimed in, and she's in the group, and she's definitely is a lender.
Yeah.
So Stacy, would you lend? What rate would you want on a 5-year term on the gap funding in these models, assuming that you like the asset and you liked the deal, right? Because you got to like the deal and got to know and like the trust whoever the partner is and stuff like that. What kind of return would you? I know you want as high as you get, but what would be a fair return relative to a 5-year term, given the economic conditions right now?
Did you say just for gap, or how long are we lending for here?
No, for gap funding.
Yeah, get like a gap, like a $16,000, $20,000, $30,000 gap funding. Yep.
Yeah. What would, on a 5-year term, what would you expect on I mean, obviously you want to get as much, but what would be an acceptable rate of return relative to other alternative investments? Because that's the trade-off, right? If you either you have something like this to invest in, or you go put your money someplace else, and what are the returns on there that's not in a non-securitized asset? So what is it, 10%, 12%? What do you think?
18 to 20.
18 to 20? Okay, that's fair.
I mean, I think you're kind of pigeonholing me a little bit in front of all these people.
Look, here's the difference. It depends on what you have else to do with the money, right?
Well, yes, it does. It depends on what else I have to do with the money. It depends on the deal for me. It depends on how much, how long, who it is, what do the numbers look like. So I can't just, I know you want me to, but I can't just.
I would call you a professional lender, right? So,
hey, Nick, can I just interrupt real quick? I can tell you right now that I just got quoted on a second lien. It was a property in Vegas. It's not my property. It's one of our students that we're working with. And they had, I think it was a $76,000 second lien at like 65%, including their first and second combined. Okay. And I think they wanted 10 and 3 points for, I feel like it was 3 years.
Yeah, but that's a
hard money. That's a professional hard money lender.
Yeah, but what's the effective rate on that? That's the question, right? What's going to happen over 5 years? They're going to probably add another point at least every 6 months to not to a year. When you extrapolate that,
it's
a lot more than what that rate is the point.
No, I know.
It's a lot more. That's it. So
because they want the points.
But here's the deal. So Stacy's at 20%. Big deal. If you don't want to pay Stacy 20%, go find cheaper capital.
Hey,
I would do the same thing.
But real quick, we just proved that 20% would work real well on that deal.
That's my whole point. So figure out what you guys want. Do you want velocity of getting in and getting out and doing more deals, and waiting an extra 3 months to get the back end?
For a bunch of
dick around, going and shopping around to save 5 points. It's like my dad driving across town to save a nickel on a gallon of gas. It's ridiculous.
No, but real quick. So when I first started the business back in 2004, and I was borrowing money at 18%, okay, and I was doing very, very, very well at that number. What I told myself was, I have an 18% partner, not a 50-50 partner, not a 70-30 partner. I have an 18% partner. That's how it worked. So now you guys have, let's just use the gap funding side. You have pay 20% of $15,000 in 36 months. You now have a $45,000 asset that you have no cost in. It's a pretty, the more we talk through this, It's like, it's a really, really, and it's underwritten the way we type and we talk to you guys about this. That's why it's so important. This is why Nick and I created this whole group for this reason. We want lenders in here. We want people that know how to go and find deals. We want people to figure out. I mean, we just got a message in our group the other day. I got a guy with 50,000 down. Does anybody have a house in Phoenix where I live? Well, yeah, I have a house. I'll find a house for 50,000 down.
Exactly.
So, all right, Stacy, we will not hold you to the fire.
Well, I'll tell you what, if I need
out at
I have no problem.
It's all good. It's all, I
Hey,
mean,
if I need gap funding, I have no problem giving it to Stacy for 18 to 20%. I can promise
well,
you.
and I mean, I always have the money to give. So I got money coming in, going out every single day, every single week. I got stuff going on, rocking and rolling. So, but if you want the money from
me, that's it, because all I know is that once I do it, I don't have to go. The time it takes me. This is very similar to what we talked about on the transaction coordination side, right? You can surely go do it yourself, okay? And you can spend an extra 10 or 12, 15, 20 hours on that file. Is that the highest and best use of your time? And I would tell you right now, the highest and best use of my time is not go shopping gap funders to save me 5 points. I can tell you that right now.
Well, and here's the other side of the velocity side on lending is that when I work with somebody who I've worked with time and time again, I have the capability to wire straight from my phone. Yeah. Okay. So I have that relationship with my bank and certain limits. So, if you want velocity, I don't have to wait in line at the bank to go to do that kind of stuff.
Right.
You know what? I think for our next call, I think we should go in a little more detail on the gap side of this, just because the cash now, cash flow, cash later, like you might still overfund for someone to pay their marketing expenses and still get that deal done so you can rinse and repeat, just so the math works. The math just has to work for you and your safety and your security. It's great.
I could work out a scenario if you wanted to, and to help you, to present.
Well, let's look at it, because I might have a couple of deals I'm going to send you over that you might want to be the gap funder on.
Okay.
I'm here. I mean, I'm not going to, maybe got one or two right
now.
Yeah,
why don't we do it? Because we're already in almost 2 hours on here. Let's do it next week. Let's do it on our next call, and we'll get you going. And we know that you do a lot of life insurance too, so that's exciting. So that'd be kind of a nice topic to reach out, because a lot of the life insurance infinite banking world is super powerful for what we do.
Very, yes.
All right, guys, we're good. I hope that helped you guys out. Hope that was value. You get into a situation, you gap funding, post it in the group, because there's other people besides Stacy that can help with this as well. And look, I'm a gap funder too, but for me, it's the term, like how long, because my line in the sand is about 12 months. So there's too much that comes down the pike that that's about my break-even point on being able to keep stuff deployed. Right. But, I use my money a lot and it sits out and it gets tied up. So I would love to get better returns. Maybe if I got 20%, I might change that a little bit. So anyway, good. All right. Thanks again, everyone. Hope this helped you guys out.
See you guys
on the next call.
All right.
Take care.
Later.